Let's start with the latest economic data. Recent PMI and IFO data disappointed. Is the economic recovery in the euro area already over before it has really begun?
It shouldn't be, and it will not be. We have seen some sideways information recently. That is true, but the big picture is that, and our projection is that the European economy is heading for a gradual recovery this year. We are projecting around 1% growth, 0.9%, and this should strengthen next year and the following year. The recovery is beginning with improved real purchasing power as inflation has come down, and stronger private consumption. And we expect that later on in the course of this year and next year, also the export markets will strengthen, and that would reinforce the recovery in Europe. That's the baseline scenario. But of course, there are significant geopolitical risks and risks related to political uncertainty following the European elections and the upcoming French parliamentary elections.
Yeah, we will come back to that later. At the same time, to the growth data, we have some disappointing negative surprises on inflation, on wages and services inflation. Do you see a risk that the disinflation process has already stalled, or do you see even a risk of a reflation as it was observed in the US this year?
The good news is that thanks to tighter monetary policy since July 2022 and reduced and stabilized energy prices, we have seen inflation come down from over 10.5% to 2.5% most recently. And this shows that we have a disinflationary process going on for the moment. We have to see the forest for the trees. That's the big picture. At the same time, there has been some sideways data recently, some less convincing data on services and wage inflation recently. But we always knew that it's going to be a bumpy road, and the last mile or last kilometer will be the most difficult. In this country, we are quite used to bumpy roads as our World Championship rally, the Rally of the Thousand Lakes, is driven on very fast but bumpy and hilly roads. It is possible to achieve your objectives even on a bumpy road.
A soft landing of the economy and a bumpy road for inflation. What does all of this mean for the interest rates? The ECB has cut interest rates for the first time now. Markets are fully pricing in one more cut this year with a slight chance of a second one. A terminal rate of around 2.5% to be reached in 2025. Is that reasonable? Do you feel comfortable with these kind of expectations?
I don't usually comment market views, but of course we are aware of market data, and they are within the frame of reasonable development. The essential thing for the decision making in the ECB Governing Council and for me personally is that we look at three factors in particular in every monetary policy meeting. We look at the inflation outlook. We look at underlying inflation neutralized from the volatile energy and food prices. And third, we look at the strength of monetary policy transmission. In light of these three factors and their developments, we take our decisions and set rates in every monetary policy meeting of the ECB Governing Council.
Yeah, but if the data develop as predicted in the projections, then it would be fair to assume further interest rate cut this year and next year?
In case we see the disinflationary process continuing and moving towards our symmetric 2% target over the medium term, then it is reasonable to assume that we stay with this direction and continue rate cuts. Having said that, I don't take any stand on when and how much. We are not pre-committing ourselves to any particular rate path.
Mm-hmm. And if you stress the data dependency of the ECB, does that also mean that you would be in favor in deciding on interest rate cuts at meetings with new ECB projections, or would you say that also in between forecast meetings there is a possibility of an interest rate cut, that each meeting is live?
I don't think we should constrain ourselves, limit ourselves in monetary policy making only to the quarterly projection meetings. We have monetary policy meetings every 6 weeks. We have new data on growth, inflation, employment, other aspects that are important for monetary policy decision making. And we can, on that basis, take decisions, and we must take decisions to set the rates in every monetary policy meeting, whether we leave the rates unchanged or we change the rates. If we were to resort only to quarterly meetings and take decisions in them, we might as well cancel the so-called interim meetings and save some fuel and save the planet. However, I would not go for that.
Yeah, but you would say that there is still some room for maneuver to cut interest rates before they are becoming, the ECB is aiming for sufficiently restrictive interest rates, so there is some room to maneuver before they are before the interest rates are no longer restrictive enough?
I think we are still quite clearly in the restrictive territory, and the aim is to ensure that the disinflationary process will continue. And we have to constantly look at, also from the point of view of, in the economics language, welfare losses, so that we do not unnecessarily delay closing of the output gap, so that we have our primary mandate, which is price stability, and this means that in the first place we have to ensure that we will reach our 2% symmetric target over the medium term, which is now in the process. But at the same time, in parallel to that, without compromising our primary objective, we also have a responsibility to support full employment, sustainable development, and balanced growth. And for me, in every meeting, we have to look at this, of course, with the primary objective in the first place in mind.
Yeah. You already mentioned the situation in France, the political turmoil there after the European elections. This is also already weighing on business sentiment. Companies are putting the brakes on investments and new orders. Is politics at the moment the biggest risk for the economic recovery in the euro area?
I think it's fair to say that especially geopolitics, due to Russia's illegal and brutal war in Ukraine, and the Gaza war between Israel and Hamas, and possibly in the wider Middle East, these are the main risks for economic development, the geopolitical risks. In more recent weeks, we have seen that political uncertainty has increased following the European elections and the decision in France to organize snap elections, snap parliamentary elections. Having said that, I don't see any disorderly market turbulence. I see a certain repricing of risk premia, yes, but not disorderly market dynamics in relation to France.
Yeah, and does that also mean that for the moment you don't see a need for the ECB to intervene? There is already some speculation in markets about a possible activation of the TPI, the Transition Protection Instrument.
That is the right conclusion. The TPI instrument implies that, or its rules imply that there needs to be disorderly market turbulence, actually unwarranted and disorderly market dynamics. And I don't see that happening now in Europe. And if all the policymakers act rationally, we should not end up in such a situation, because the French economy is relatively strong in its foundation. There have been quite important structural reforms. Employment rate is high, and the banking sector is in strong shape. So the fundamentals of the French economy are actually quite good, apart from the growing debt and the fiscal deficit, which has to be dealt with.
Yeah, but do you see a risk that the turmoil could, given the elections, escalate further and also spill over to other euro area countries, triggering a kind of a euro debt crisis we have seen back in 2010, 2011, when you were commissioner?
I don't see that in the cards. A central banker has to always be worried, has to be concerned about, but it has to be calibrated concern. And what I mean is that if you think of the euro area 10, 15 years ago, during the Eurozone debt crisis between 2009 and 2012, that was caused, the root cause was then macroeconomic imbalances. The macroeconomic imbalances in several, mainly Southern European member states, which were also related to the first decade of euro and mispricing of risk in the bond markets at the time. Now, these countries have by and large stabilized their economies. Greece is one of the best performers in Europe. Spain and Portugal have been doing relatively well, and they have seen also quite significant labor-related immigration from Latin America. So this kind of a broader Eurozone debt crisis is not in my radar screen. But of course, as I said, political uncertainty has increased, and I hope that in France the policymakers and the citizens can deal with that and make sure that this political uncertainty will not be creating further problems neither for France nor Europe.